A very warm welcome, everybody, to Deutsche Bundesbank. Jens Weidmann, you know him, the president of Deutsche Bundesbank, Joachim Nagel, member of the board of Deutsche Bundesbank. His responsibilities are, among other things, controlling and preparing the accounts and the balance sheets. This press conference is broadcast live onto the internet, and this also holds true of the questions. So please always wait until you get a microphone before you take the floor. And something else, there'll be headphones available, so you can actually listen to the simultaneous translation of the press conference in English. So let's start right away. Mr. Weidmann, you have the floor.
Thank you very much, Mr. Best. Let me also say a very warm welcome. It's good to see you here today. When it comes to annual accounts, and more particularly the balance sheet, as you know, they reflect the environment that an institution such as Deutsche Bundesbank acts within, and it also reflects its own action. And that is why I would first like to take a look at the environment before Dr. Nagel and myself will then present the annual accounts to you. Again, low inflation rates were a determining factor in the monetary policy debate last year. Consumer prices only rose at 0.2%, which was even more subdued as in 2014. Any projections, including those of the Eurosystem, also suggest that inflation will only draw closer to the target of close to but under 2% slowly, which, as you know, is the definition of price stability used by the Governing Council of the ECB in the medium term. When it comes to this factor, consumers welcome this with respect to their purchasing power, but for monetary policy, this leads to discussion of its credibility and a lower safety margin to the zero lower bound, limiting the scope of action responding to any potential future adverse developments. Inflation developments led to this debate at year-end and also earlier this year, a very intensive debate in the Governing Council. And as a consequence, the Governing Council decided in January 2015 not only to buy certain private sector assets, but government bonds on a larger magnitude, and to do so for 19 months. In its early December meeting, the Governing Council extended this program by another 6 months. It now runs until March 2017. The deposit rate was reduced to minus 0.3% in addition. In other words, banks have to pay a higher rate for their excess liquidity at the central bank. In the monetary policy meeting early in March this year, the ECB staff will give its updated projections for economic output and inflation developments for the period between 16 and 18 rather, and on this basis the ECB Council, the Governing Council, will review the monetary policy stance then. When it comes to the real economy and developments there, more recently there have been doubts about the international environment still provides the impetus to the euro area assumed in the December projections of the Eurosystem. The latter assumed a moderate but steadily rising upward trend. Some doubt was recently cast on global growth prospects. More recently, for example, you saw this when looking at the economic figures for the US that were received with disappointment, also in Japan, but also increased political uncertainty when it comes to the future reform program of some Euro countries and the future composition of the European Union. Moreover, there are concerns with respect to the future earnings position of banks and corrections of exaggerated expectations with respect to the ability of monetary policy to solve structural problems. And these doubts have now reached international financial markets and led to a quite pronounced risk aversion since the start of the year. As a consequence, more risky assets were replaced by safer assets. And accordingly, shares, equities, in particular financials and corporate bonds, saw their prices going down, sometimes significantly, while government bonds, for example, American, German, French, but also those of other euro area governments were more in demand. This rebalancing was accompanied by clearly increased price volatility in almost all financial market segments. Some volatility can prove that markets are functioning, which is why we don't have to end up with a totally negative assessment of those. Although, on the other hand, an extended period of high insecurity in the markets could provide an additional burden to the global economy because it will lead to a more difficult situation for companies when raising capital, which will become more difficult and more expensive. China is something that the markets have focused on, and the economic development in China. It is true that growth in China has slowed down, but there is no indication at the moment showing a sharp downturn. The shift in China's growth has been quite in line with the transition of China towards a more service-oriented economic model driven by its domestic economy. There are signs of a changing assessment, however, when it comes to another factor which is significant for the current development, and that's the oil price. For the global economy in total, the ongoing decline of oil and commodity prices seemed to become a burden increasingly. This decline has reached a proportion that was at times self-reinforcing because producers responded to falling prices by increasing their production in order to stabilize their revenue. Many countries with a strong dependency on oil or commodity exports. Mr. Best, do you need a pen? No problem. Many countries are on the verge of a recession. Countries depending on oil and commodity exports, that is, or are in recession already. Government revenue is collapsing and the deteriorating budget position cannot be compensated for so easily with the existing buffers. And that's why public and private expenditure is cut. And that's something that exporters in the euro area are feeling. The more pessimistic growth outlook in many emerging countries also led to an effective appreciation of the euro in trade-weighted terms, leading to an additional slowdown of exports and inflation in the euro area. It is true that for the euro area, the declining oil and commodity prices should continue to support the economic development and trend. Compared to the December Eurosystem staff projections, energy prices have declined further and so strongly that consumers and companies will probably see their expenditure reduced by 1% of GDP. And that's true for Germany and the euro area in total. This transfer of purchasing power from oil exporting countries to euro countries does not translate into consumption or investment on an identical level. But even if some of the amounts are used for saving or reducing debt, this will help solve one growth inhibiting factor in the euro area, and that's the high level of debt of many consumers and companies. But there is no reason for doom and gloom generally, because all in all, the economic prospects of the euro area continue to be on the upside. The gradual economic recovery of the euro area is expected to continue in the current and next year. We currently assume that over the projection period, the output gap will continue to close, which will mean that domestic inflationary pressure will become stronger. On the other hand, the repeated fall of the energy prices will delay the increase of inflation towards the target, which has been sluggish anyway. In December, the average assumption was 1% when it comes to increasing consumer prices. And this forecast will not be able to be upheld given the oil price decline. During the first half of the year of 2016, inflation rates of below zero have become conceivable again. For monetary policy, the short-term inflation outlook is less relevant, however. All the more so when this reflects energy prices predominantly. Adjusting for energy price volatility, the inflation rate for the euro area is currently 1%. This indicator of domestic inflation or domestic inflationary pressure is also below the medium-term target when it comes to price stability, but it is rising over the period and is far away from a level of deflation where the scope of monetary policy would be significantly restricted and a self-reinforcing downward spiral might start. For monetary policy, it's the medium-term price expectations that are key. And within that, the main point is the risk of second-round effects related to the oil price decline and low inflation rates. Such a loss of confidence could make it difficult for the euro system in future to fulfill its monetary policy mandate. Lower inflation expectations mean that at a given level of nominal interest rates, real interest rates will rise, which will mean that monetary policy would be less accommodating. Now, it emerges that since the start of the year, longer-term inflation expectations have gone down. Since the start of the year, financial market-based data indicators have declined when it comes to inflation expectations. One reason of the decline could be that there have been safe haven capital inflows into the euro area triggered by the aforementioned higher risk aversion to inflation on financial markets. In addition, indicators of market-based longer-term inflation rates also include a safety premium against surprises from inflation. Currently, investors want to protect themselves against a phase of surprisingly low inflation. And that's why financial market-based data of inflation expectations in the amount of 1.4% might underestimate the actual long-term inflation expectations of market participants. That's suggested by a comparison of survey-based longer-term inflation expectations, because according to ECB surveys, they decreased only a little to 1.8%. The consensus economics survey results even hint at a slight increase. It would be an indication of a de-anchoring of long-term inflation expectations if market-based inflation expectations responded more strongly to surprises from published inflation or other economic indicators, responding more strongly than before, that is. This would mean that the definition of price stability established by the central bank would become less relevant as an anchor. But a current survey of the Bundesbank does not find a statistically significant indication of this. That is a loss of confidence of market participants in the stability orientation of the ECB. Second-round effects could also be reflected in lower wage agreements, however, and some see the current wage increase rates in the euro area as a warning signal. My assessment of these, indeed moderate wage increases, is different. They are probably rather the expression of an employment-oriented wage policy, which is also necessary, because some euro area countries will have to increase their price competitiveness even further in order to win back world market shares that were lost in the global crisis. This moderation in wage increases does dampen wage growth, but in the countries affected, it supports competitiveness and employment, strengthening demand in the general economy in the process. Ladies and gentlemen, the risks for the general economic development have certainly increased, and as such, inflationary pressure would go down. As a consequence, there is a debate on further easing of the very accommodating monetary policy stance of the ECB. Such a monetary policy reaction could have risks and side effects in the long term, however, that must not be simply ignored. With the currently planned purchasing volume of the asset purchase program, the euro system will become the largest creditor of member states. For a large proportion of government debt, the funding cost of the government are thus de-linked from capital market terms and conditions. For that portion, governments pay interest to the central banks, and they pay some of that interest as tax to governments. And the outcome of that is that governments would receive funding at the deposit rate because the asset purchases ultimately increase the excess liquidity of banks. Differentiating the interest according to the sustainability of government finance is something that will not take place for those assets anymore. Weakening the discipline effect exerted by the market that should ensure sustainable fiscal policy in addition to budget rules. And once governments have got used to these historically low financing terms, this could lead to increasing pressure later on to maintain the asset purchasing program longer than needed for monetary policy purposes. And that would be true whenever the extraordinary low funding cost saved is not used to consolidate budgets, but used for a less sustainable fiscal policy. And that exactly is what's happening. When you take out the lower interest expenditure from structural budget deficits of the euro area countries, they haven't only improved for 2 or 3 years, they've rather deteriorated. The opportunities for a fast reduction of government deficits, budget deficits, presented by low interest rates are not used. QE will also lead to financial market actors, in particular banks, entering into risks more willingly. When low-risk assets return lower yields nominally, then actors will buy more risky and higher yielding assets as part of their portfolios. A survey was carried out by Bundesbank and BaFin among 1,500 small and medium-sized banks. The result was that in this low-rate environment, they didn't only opt for riskier assets when rebalancing their portfolios, but also responded by increasing the average maturity. To a certain extent, this higher risk appetite is deliberate and welcome, because higher yielding investment comes at higher risk quite often from the economic and business perspective. But supporting the risk appetite with monetary policy amounts to a balancing act. In the run-up to the financial crisis, we know that investments were made that were too risky and unproductive because of these low rates in many countries at the time. A current survey of the Bundesbank takes into account this risk appetite channel and shows, similarly to studies by other economists, by the way, that in those situations it could make sense to pursue a slightly less accommodating monetary policy, because according to this analysis, such an approach supports and promotes the tendency of banks to enter into risks that are too high. Of course, whenever there's a risk to financial stability, macroprudential policy is called into play and is called for. But in a monetary policy which should be oriented towards long-term price stability, these risks cannot be ignored, because ultimately financial stability risks will also be a threat to price stability. The financial crisis showed that clearly. But we shouldn't overburden macroprudential policy, because in the euro area, we're only in the process of developing its instruments and gather some first experience of their effects and effectiveness. The low-rate environments places earnings of financial institutions under particular strain, and that's also reflected in bank shares and their price volatility in recent weeks. It leads to questions about the effectiveness of monetary policy stimulus when it comes to banks. In the short run, banks will benefit from low rates because their liabilities or lendings will have shorter maturities than their assets. Refinancing costs will be incurred before the income from assets come in. But the longer rates are low and the lower they are, the lower the interest income of banks and the lower their profits will be accordingly. And in the current low-rate environment, that is particularly true, because for reasons of business policy, but also competition policy, it is difficult for banks to enter into territory of negative deposit rates for their assets. That's at least the outcome of this survey of Bundesbank and BaFin among 1,500 small to medium-sized banks. With respect to our own projections and calculations, or with respect to their own calculations and forecasts, bank report declining profits before tax by 1/4 until the year 2019. Given the low rate environment, and if it continues, this could rise to 50% lower profits, and compared to a further fall in rates and assuming unchanged levels of total assets, this could be by up to 75%. Central bankers are, of course, not working in favor of profits of banks as such, but their work is about monetary policy effectiveness. German banks have strong reserves on their balance sheets, are well capitalized. The average core tier 1 ratio has increased to 15.6%. Is almost twice as high as before the financial crisis, 8.2% in 2006, which should mean that financial institutions should be able to be resilient to macroeconomic shocks and economic difficulties. Nevertheless, banks will have to realign and restructure in such a way that they'll be profitable in a sustainable way. They have to reassess their business models and use the scope for consolidation to cut their cost. Otherwise, in this continued low-rate environment and given limited access to capital markets, it might be difficult for them to retain or plow back profits and strengthen their capital on that basis when necessary. BaFin and Bundesbank as supervisors will closely monitor those banks that have proved particularly vulnerable in this low-rate environment. In addition to the general and country and financial institution-specific factors of stress, there was one decisive regulatory change effective from the 1st of January 2016 that should have had a significant impact on the funding cost of banks. And what I mean is the absolutely necessary regime change from a bailout regime towards a bail-in regime. When a bank is stressed, the owners and certain creditors will be called upon, will be bailed in more strongly than in the past. That is the right thing to do because risks will then be assumed by the investors. After all, they entered into those risks initially. And this new regime will reduce the incentive for banks to enter into risks that are too high and have taxpayers assume the consequences. Taxpayers are now the last resort, not the first line of defense. However, interest rates on bail-in eligible debt has increased. Prices for these CoCos have gone down, not only for banks in stressed countries, but also in the core countries. And that's an indication that banks in Europe are now assessed less according to the sovereign risk of the country they operate in, their home country. And that is moving in the direction of banking union, in fact. In order to improve banks' prospects, there will have to be another prerequisite. And that's the successful conclusion of Basel III this year. First of all, banks will become more stable based on the reviewed regulatory framework. A lot has been achieved here. And second, the regular discussion must not become a factor of uncertainty itself. Financial institutions will have to be able to adapt to the new regulatory regime. They need sound assumptions for their planning. Market insecurity with respect to regulatory requirements will be stabilized on this basis, and the financial burdens incurred with these regulatory changes will become more predictable on that basis. Given all these challenges, we must not overlook that the German economy and German businesses are in good shape at the moment. And this allows our domestic bank low provisioning levels and supports their earnings. The positive economic situation in Germany is also reflected in employment, reaching a record high last year, with unemployment declining further. Labor income increased significantly while inflation was low, which means that real disposable incomes increased perceivably by 2.2%. Private consumption was accordingly the main driver of the economy last year. This year, buoyant domestic demand should again be a key driver of economic developments, which will be on the upside despite slightly increased risks. The economy will be boosted by the very low energy prices on the one hand, but it will also be supported by high expenditure for accommodation and support to refugees. Given these tailwinds and the generally positive environment, the growth rates predicted are not very dynamic, however, and the cause of that is the unsatisfactorily low long-term growth trend in Germany, which has been weakened by the demographic development and political decisions in recent years. And this clearly underlines the necessity to give an ongoing boost to growth factors in Germany as well. The long-term growth prospects are also a main impediment to private investment in addition to the current insecurity. And they explain why, despite low financing costs and more or less normal capacity utilization, there is no more investment than we see. It was also something that we dwelt upon in recent weeks, as you know. Expenditure incurred in connection with refugees could account for half or a quarter percentage of the gross domestic product in Germany for this year and the following year, respectively. Nevertheless, we expect a balanced government budget for Germany when it comes to the following 2 years, more or less balanced. When it comes to immigration, the longer-term perspective will be more important. In the coming decade, many will reach the age of retirement, and the baby boomers will retire, that is, and in the labor market that might lead to gaps, and labor market-oriented immigration could account for that somewhat. Of course, we receive refugees for very different reasons, wanting to offer them refuge, and their qualification is not ideal for our labor market. The more we solve the existing deficiencies in terms of language and qualifications or skills, the higher the likelihood for those who will stay here in the long run to earn their living in the long run. And this will not only give a boost to the self-confidence of refugees, but also facilitate their integration in society. And successful integration, of course, will help to reduce the cost of this measure that, let me repeat, is based on humanitarian considerations. Even when integration into the labor market is and will be successful, we will need patience, and it would be an illusion to think that immigration will help solve our demographic problems. It's not only Germany, however, that's faced with challenges. To give a boost to growth drivers and make the euro area less vulnerable in the process, significant efforts are required by all euro area countries. On the European level, there is a lot of untapped potential as well. In addition to capital market union, I think of the creation of a common digital market and the completion of the common market for services. The biggest challenge, however, is certainly to give the monetary union a robust and consistent general architecture. The architecture of the euro area is insufficient when it comes to stability. A decision is needed because in a vulnerable monetary union with hardly any growth, monetary policy will always be under the pressure of being called upon to solve structural problems with cheap money. In a monetary union area, the key factor is that some problematic developments in one member state must not jeopardize the stability of the whole union. There are two ways of solving this. On the one hand, it is possible to establish a framework based on responsibility, making sure that problematic development in one member state should be prevented. And if they cannot, they shouldn't provide a risk for the whole monetary union area. The other alternative would be shared responsibility for fiscal and economic policy on the supranational level, a fiscal union. both would be ways forward to bring action and its consequences or liability in line with each other. A real fiscal union would mean that action and its consequence in terms of responsibility or liability in the euro area would be in one hand, in European hand, that is. A fiscal union would no doubt be the biggest step in the European integration process ever since the launch of the euro, and without substantial amendments to the EU, to the agreement establishing the European Union and the national constitutions, no sovereignty will be able to be transferred, not in the amount needed. So the political obstacles are high when it comes to achieving a real fiscal union. If no sufficient political support is established or can be reached for this, the only solution will be to solve the weaknesses and contradictions of the Maastricht framework. And that is something that I pointed out to my French counterpart Villeroy de Galhau in the past and repeatedly in a joint contribution. There are many tackling points for such improvements. One would be the automatic extension of government bonds whenever a government asks for an ESM program, and the reduction of privileges of government bonds in banking regulation. Government bonds could be designed in such a way that their maturity is extended by 3 years automatically as soon as their government asks for ESM support. And the financing requirement under an adjustment program would go down dramatically, and European taxpayer money would only be needed to extend fiscal adaptation and adjustment over time and make the adjustment program more socially compatible for the citizens of the country involved. It would not be needed to redeem expiring government bonds, replacing them by ESM loans, that is, dismissing investors from their responsibility in the process. The second area of reform is the so-called doom loop, lifting the privilege of government bonds and solving the problem of ties between government finance of a country, of a member state, and the stability of the banking system, which has been too close. This doom loop fueled the flames in the past. The current incentives for banks to fund their government's debt in an unsound and unsustainable way must be reduced by making sure that even government debt has to be associated with equity and a ceiling. And when that regulatory privilege is abolished, the incentive for banks would increase to take into account the different risk profiles of governments. And this would strengthen discipline exerted by the capital markets. Unsustainable policies would then lead to increased risk premiums for those member state governments. It's encouraging that the regulatory treatment of government bonds is now on the agenda of different bodies and will be discussed on the international and European level very actively this year. Ladies and gentlemen, the current monetary environment meant that the imagination of some academics was fueled as to how to improve the monetary policy legroom, so to speak. They suggest abolishing cash. The current interest rate policy of the euro system, but other European central banks as well, show that the zero lower bound is not the absolute lower bound for interest rates by central banks, but it's uncontested that this can lead to alternative reactions in terms of holding cash if rates went down too far below zero. If cash was abolished, central banks would be able to impose negative rates across the board. But from my perspective, that response would be wrong and disproportionate. My response would be that the growth drivers in the euro area should be strengthened, making higher nominal rates possible again. This discussion about the abolition of cash, which is motivated by monetary policy debates, has to be kept separate from the current discussion of the limits in the use of cash, because the proposal to introduce ceilings for cash transactions and the initiative to abolish 500 euro notes these proposals are based on fighting the financing of terrorism or money laundering. I think the goal as such is worth supporting. However, I think there is some doubt as to whether terrorists or criminals will be impeded by this ceiling of cash transactions or abolishing high denominations. And there is one evidence pointing in that direction. In the US, some call for the abolition of the $100 note, which is deemed as still too high in this context. When it comes to the different forms of payment, the Bundesbank's stance is neutral. We want to afford our citizens the form of payment that they wish to use. And that is why we ensure that cash in circulation comes at a high quality level and is available in the amounts needed. And with our target system, we offer the backbone of cashless payments. Now, it's a fact, of course, that Germans appreciate cash a lot because they think that it comes with a number of advantages. And in our annual report, we analyze that in detail with very interesting results, I think. The upshot is that cash is the most popular form of payment in Germany still. Almost 80% of all transactions at the point of sale are done by cash. Germany is at the top of the league together with Austria, as a study by the Bundesbank shows. Today, we also publish a research letter associated with this study. This is in line with a new series of publications by the Bundesbank, where in the future we will be offering interesting research results in a concise and brief way to an interested public and experts. It's also available outside, so feel free to take one and get a first-hand view of this new publication. The importance of cash payments has decreased in recent years. That is true, but the payment behavior is only changing gradually. Card payments, smartphone payments, or online shopping is something that the younger generation is using predominantly and find appealing. I'm not sure we on this panel are part of that. I have my doubts. So these forms of payment are increasing, but not very fast. One contributing factor to that should have been that cash payments are not particularly expensive as a form of payment. Even some think that is the case. When it comes to the cost per transaction, cash beats both debit cards and credit cards, significantly so. When you relate the cost to the revenue of the transaction, which is usually higher for card payments, cash is inferior to debit cards, however, but it still performs better compared to credit cards. So there are sound arguments in favor of cash, and that is why I'm not surprised that in surveys, more than 3/4 of all respondents, sometimes even more, state that they do not want to go without cash. In my view, it would therefore be very problematic if the general public was under the impression that the discussion about abolishing the 500 euro banknote and the ceiling for cash transactions are to be seen as steps towards abolishing cash in general. The current focus of the public debate on cash should, however, not prevent us from seeing that cashless payments in the future will come under significant changes in the future. And I think the blockchain technology has to be seen as the key innovation because it affords low-cost and relatively anonymous transactions without the use of central agencies, banks, card companies, or clearinghouses. And in a similar vein, bitcoins using this technology are conceivable. And I could imagine a situation where they can be traded in decentralized systems the same way as shares, bonds, or derivatives. And of course, that would mean a challenge for the existing payment and settlement systems. And that is why it's not only financial service providers, but also central banks carrying out research whether this highly interesting technology is something that lends itself for volume transactions. And that's why the Bundesbank is the member of a working group at the Bank for International Settlements in Basel. Ladies and gentlemen, let me conclude with what you've all been waiting for, our annual accounts and this year's net profit of the Bundesbank. The P&L for 2015 closes with an annual net profit in the amount of 3.2 billion euros. The net profit for 2015 is thus 0.2 billion euros higher than the previous year's level, although, well, there's an explanation as to that at the back of the report. Net interest income has declined. We discussed that at the last time. I gave you a forecast of that. On the other hand, net income from financial operations, depreciation and provisioning has increased. And all in all, on balance, that led to this slight increase year on year. The main driver of that is a cautious reduction in our provisioning levels. Traditionally, risks in our balance sheet are primarily based on currency holding or foreign exchange holdings. Between 2010 and 2012, further substantial risks were added in the form of the SMP assets, the refinancing assets, and the Euro Asset Purchase Portfolio, CBPP, CBPP2, and our own portfolio. And accordingly, our provisioning level was increased between 2010 and 2012 in 3 steps, totaling 14.4 billion euros. In the meantime, the risk from refinancing loans and SMP assets have decreased because of lower holdings. Previously, they were in the focus of our provisioning levels. And in contrast with the 2 previous years, the expected result for 2016 and the risk cover potential of the bank is no longer declining. On the other hand, the ABSPP, the CBPP3, and the PSPP asset purchase programs lead to additional credit risks, but in a lower magnitude than assumed a year ago. With these asset holdings, we also incur interest rate risks. When it comes to our risk provisions, we have not taken them into account yet, but we are aware that they will significantly increase in importance in the future. Our total provisioning level was reduced by 0.8 billion, totaling 13.6 billion right now. Ladies and gentlemen, with this overview and some of the cornerstones of our annual accounts, I'd like to close my part, and Mr. Nagel is now going to present the accounts to you in more detail. After that, there'll be a Q&A. Let me thank you for your attention at this point, and thank you again for being here.
Thank you, President Weidmann. Ladies and gentlemen, now the President already mentioned this. I'd like to explain some details and specific features of our balance sheet and P&L. Starting with page 71, you'll find everything also in more detail, all the numbers that I'm going to mention. Our balance sheet 2015 continues to be driven by monetary activities in the context of the financial and sovereign debt crisis. Total assets increased by 1 billion euros. Because of the monetary activities, breaking the sonic barrier of 1 billion as already in 2012. Particularly important on the asset side is the liquidity inflow from other European countries, which are reflected by an increase of target 2 claims to ECB of 123.4 billion to a total of 584.2 billion euros. Second important reason for the increase of the expansion of the balance sheet is the monetary policy asset purchasing programs. The President mentioned this. Holdings of euro assets in total increased by 122.1 billion to a total of 172.3. The purchasing program of German government bonds alone, as part of the PSPP program, led to a total of assets held of 104.2 billion euros, and year-end purchases as part of the covered bond purchase program 3. This increased the covered bonds held by 23.8 billion to a total of 40.4 billion euros. Government bonds from the S&P program discontinued in 2012 were reduced by 5.9 billion because of maturities to 27.7. The liquidity from abroad through purchasing program is reflected on the liability side, here in particular through the deposits of banks with Bundesbank, which increased by 118.5 billion to 208.7. Then, as far as the liability side is concerned, they are here summarized under monetary policy operations. This also covers the euro deposits of other domestic and non-domestic depositors, which increased by 76.9 billion. There was also an increase of the volume of the banknotes issued by Bundesbank by 44.2 billion to 552.6, an increase by 9%. Interesting also to see the adjustment items from revaluations. An increase is what we see here by 1.2 billion to a total of 105.7 year-on-year. Forex effects lead to an increase of revaluation reserves by 3.1 billion euros as far as gold is concerned. However, the revaluation reserve was reduced by 1.7 billion. There are some counter-running effects behind this. The gold price in US dollars at the year end was about 12% below that of the previous year. The currency effects or forex effects, however, led to a situation that the price is only 1.5% below that of the previous year. Long term, the revaluation reserve of gold shows a significant increase compared to the status at the beginning of the monetary union. It is about 5 times the highest at the beginning of 1999, and that despite the price decrease in 2013. Slide 7, profit and loss. The most important component is the net interest income, which was reduced significantly from 3.1 billion to 2.3 billion, the lowest level ever since the beginning of the monetary union. The reason for that are the lower key rates, 2/3 over the year, but also the decrease in monetary asset portfolios because of the maturities. That's the purchasing SMP program that was discontinued, and of course the covered bonds CBPP and CBPP2. The net result from financial operations is at 1.7 billion compared to 0.5 billion year-on-year because of higher realized profits from forex transactions and the lowering of the provisions for general risks already mentioned by President Weidmann. Income from participation or participations were reduced by 585 million to 282, and the net results from monetary income from 213 million to 133 million because of special effects in the previous year. Staff cost was at 722 million, which was 189 million lower than the previous year because of one-off effects, which led to lower provisions for pensions. Without these effects, the increase would be 2%, mainly due to general salary policies and a slight increase in the number of staff. Other administrative expenses, including the printing of notes, increased by 136 million, in particular because of pro-rata development expenditure for Eurosystem projects and the printing of notes. Other items, an increase here by 131 million, in particular because of cost contributions of the Eurosystem central banks to the development expenditure of Bundesbank for the Eurosystem project T2S. The P&L for fiscal year 2015 ends with a profit for the year amounting to 3.2 billion compared to 3 billion of the previous year. Thank you very much for your attention. And now we have time for questions and answers.
Okay, Mr. Waldmeister, could I suggest that you should ask the first question? Microphone.
Well, Mr. Weidmann, a very good morning. The interest rate risk, you mentioned this, and you mentioned that this was more in the focus of this year, and you announced really that risk provisions would be increased here. After all, you just reduced it before. The interest rate risk is a risk which you as a central bank, of course, can also determine to a certain extent. You can manage it to a certain extent. Can you maybe tell us what we have to expect here? Because, well, so actually we have had announcements already of the interest rates staying low. Answer. I think you've understood what I've said quite correctly, and you interpreted everything correctly. I just wanted to hint at a situation where this time next year there might be some new risk provisions with a significant volume which might have to be discussed, but I don't want to preempt or anticipate this discussion now. Basically, if you want to have a monetary policy discussion with me, that's one thing. We can do that, of course. The important thing in this context, however, the important issue is for me to say here that as far as monetary policy decisions are concerned, do not serve to make a profit here for our bank. We are looking at price stability only. So basically, we have to accept certain losses if this was deemed to be necessary for monetary policy reasons. This is very important to give you some background to the discussion here. One thing is clear. We are right in the middle of the implementation of a very comprehensive program of purchasing sovereign assets, government assets or bonds, and we are going to keep it on our balance sheets for quite some time, but maybe sometime in the future the risks might be different, depending on how we actually decide to terminate that or what the interest effects will be, because this might also lead to an interest rate risk. Mr. Baumgartner, if you'd like to continue, and we do need a microphone in the middle of the room, hands up, and then, yeah, show of hands, and the lady will see where to take the microphone. 2 questions. First of all, the target 2 volume, there was an increase, an enormous one, in spite of the relaxation or accommodation. So what about the peripheral countries and the adjustment there? Isn't there an impediment to that? Gold. So when gold was not sold, this was with the reason that deficits shouldn't have been affected. Now, deficits do not exist anymore. Might this have an impact on this particular decision? Concerning Target 2 and Target 2 claims. Now, the interpretation was that these balances were shown as certain distortions in the markets, something that Germany would then receive as liquidity. The increase that we see here on our balance sheet can only be understood when we also understand the mechanics of the purchasing programs, which can also lead to a situation where the Target 2 balances go up. For example, because of the fact that those who actually sell government bonds to the euro system are located in Germany so that the liquidity stays here. There is a certain connection with the PSPP, and as far as the valuation goes then of Target 2 balances, this would turn out to be different. Our reasoning has always been that the Target 2 balance is not the reason of anything, but we take it as a thermometer, a fever curve showing the situation in the markets, something that might also reflect a certain level of mistrust in the banking sector. This time, of course, there are some other facets when it comes to interpreting the Target 2 balance. As far as your question concerning the potential selling of gold is concerned, now, we've stated time and again that gold was only used by us to sell for minting gold coins, but nothing else. Because as far as the gold that we hold is concerned, we consider this to be an important anchor into the value of our balance sheets. As far as other balance sheet items are concerned and other receivables that we got, gold is not a receivable vis-à-vis third parties, so there is no default there. There is the risk of the value changing, but there is no risk of default. So this really corroborates and supports the trust and confidence in the value of our balance sheets. And this is also a type of reserve that can also be converted into other currencies should they prove to be necessary. And this is also why we've got the deposits here and why we have the gold and store it. So it's still the same attitude as before. Gold will only be sold in small quantities to the German sovereign for gold coins to be minted. Mr. Siebel, next. Two questions, actually. First of all, I'd like to know whether next year we have to expect the profit to decline again. Should there be some new type of risk provisioning? And the second question would be, so the major asset purchasing programs of the ECB started in 2015 already, and you do have quite a bit of that with the purchasing of government bonds. Is there already some kind of scarcity in the market? Any change in the markets as far as these purchases are concerned? Thank you. So I think you'd have to wait until next year in our financial accounts conference next year when you want to hear something about the profits, the profit situation, the profit for the year. But I think I've provided some answer already. So profit for the year has started to stabilize. And as far as provisioning is concerned, there will be some changes, but there's going to be more. The interest rate risk is also to be considered, because the S&P portfolio, there's also some decreases there. So when you look at the net effect, that's what you have to look at. And now we will actually have to see what the items are like, and then we can discuss the whole matter again. Concerning the second question, Mr. Nagel will be able to give you some more detailed answer here. As far as the range of the PSPP program is concerned, this is not just due to the available universe, as we call it, of bonds that can be bought, and the restriction of the governing council of the ECB, but it is also the general market environment that plays a role here, because it's one of the conditions not to buy below the deposit rate. We don't have any difficulties to get the amounts that we actually want to purchase. No scarcity there. And secondly, I do assume that the program can be implemented and we will find sufficient volumes available in the market. Now, to add to this answer, as I stated before, net interest income last year already did decline. And the year before, 2014 that was, the average rate was 0.16%, last year 0.05%. So net interest income, of course, suffered from the general environment. Concerning the second question, the President mentioned this before. As far as the purchasing program of bonds are concerned, sovereign assets, there is no restriction that we see when it comes to purchasing them. So the program does continue for some time, will continue. There are substantial volumes to be moved in the market. Liquidity is something that you need to monitor and watch very closely, because should there be some scarcity, well, liquidity then leads to higher volatility. Volatility in turn, when it comes to the banks, and their risk models usually leads to a situation that more equity needs to be provided for this volatility. And there's another feedback effect because there will be another reduction of liquidity. So we keep watching this and we have to keep watching it. But as far as Deutsche Bundesbank is concerned, there is no bottlenecks yet. Next question, Ms. Ettel. Thank you. The feedback effects and the risks. From your point of view, how big is the danger, as far as you're concerned, that we have the doom loop going on already? So where negative interest actually eats up the profitability of banks to such an extent that the general economy suffers, which would lead to even more negative interests then. Second question, equalization of burdens amongst the issuing banks, so the bond purchasing programs. There is a certain amount of risk that's shared or distributed amongst the issuing banks. As far as the negative profit is concerned, shouldn't that also be distributed amongst the central banks, more so than before? We did have this debate before, or it's been ongoing. What about the status at present? Could you remind me of the first question again? The doom loop. I'll start with the second question, though. So, interest rates. There is a risk factor and also a risk premium. The risk premium is paid where the risks are borne in the PSPP. That's the purchasing issue in banks. You pointed that out before. The loss sharing was mainly cancelled out, which is major progress, of course, when you look at the previous purchasing programs, because if there is no loss sharing anymore, at least not to the extent that we had before, if you have that situation, of course, one must admit and accept that higher interest payments actually occur where there is higher risk. Whether it's the zero lower bound, that's a different question. If there is a negative interest, it doesn't really make any sense to have this division, the split. The underlying assumption is that the other central banks know how to handle these risks and do make provisioning there, which of course also do reduce the profits, something that we did see in the past. My outlook as far as the business situation is concerned, or the general economy is concerned, I'm not quite as negative as some others, or maybe quite as negative rather than it's been reflected by your question. I do believe that, not just for Germany, but for the euro area in total, that all in all, we find ourselves in a gradual upward movement. The baseline, of course, still incurs higher risks, but it's still intact also. So no doom loop as far as I am concerned. However, when we look at the monetary policy discussions, what we have to consider there, so if there is need of action in monetary policy terms, that's the first thing that you need to discuss. So midterm price perspectives, how far away are they from our definition of price stability, and therefore require our need to act? So if there's a positive answer to that question, then you also have to face the discussion concerning the instruments available to central banks with the intended effects, but also with the risks and side effects. And as far as that is concerned, it's the net effect that counts. I understand your question in the sense that this net effect ought to be considered and paid attention to, so I fully agree with you. And there are some facts as far as the effects, as far as the earning capacity of the bank is concerned. And with this very high volatility, that's exactly what we've seen in these recent weeks, which effects that also need to be considered when assessing the different instruments. If the monetary policy measures lead to less loans being granted, then I think that would have been counterproductive.
The next question is by Mr. Marlin, over there. Thank you. Let's see. Thank you. On the one hand, there is a declaration of the Governing Council, an announcement that is to have the intention of abolishing the 500 euro notes, and the Banknote Committee now looks at the technical requirements. And one option would be to set a period over which 400 euro banknotes would still be accepted. Could you perhaps give us your view on that at some point it might no longer be accepted? My second question is this. In March, the Governing Council will present its latest projections on inflation. Do you have a limit where, from risk management considerations, you would be saying that there is need to act in terms of monetary policy? And if possible, I also have a technical question to Mr. Nagel. Could you tell us again about the level of profits of the Bundesbank from the S&P profits and from the negative deposit rates for the banks? Okay, I'll take a little longer with my answer that we will give my colleague the time to find the numbers. I don't know of any declaration by the Governing Council to abolish the 500 euro note, nor has there been a decision on that. You're right in saying that there is a discussion in the Governing Council, and there are certainly opinions when it comes to, or there is a general picture when it comes to the opinions of the members of the Governing Council. And the Banknote Committee has been tasked with looking at the technical requirements. When it comes to putting it into practice, potentially, you must not underestimate the requirements associated with abolishing the 500 euro note, because we'll be discussing about abolishing 1/3 of the circulated money, essentially. You also have to consider that in the past, we saw time and again that Germans, including all us here in this room, I guess, don't have a lot of 500 euro notes in their wallets. At least for me, that's the case. But the high denominations are still useful in certain situations. When it comes to logistics, the supply chain, if you want. For example, in a situation of high insecurity, where you would want to ensure the supply of cash to the system, situation that we saw in the financial crisis. Ultimately, making sure that central bank money will come out of the ATMs in such a situation of increased uncertainty. So it's totally right that the technical committee is looking at the technical requirements for that. And one important argument when discussing this, in my view, is this. We will not damage trust and confidence in the euro. And you mentioned the discussion about one aspect, abolishing the 500 euro note. And in my view, that is something that could impair the trust by citizens. If we tell EU citizens that the banknotes they are holding now will at some point no longer be valid, then that would have a negative impact on trust in the currency. And that was one of the reasons why Deutschmark banknotes were able to be exchanged against euro notes in an unlimited manner. On the other hand, this shouldn't only be about the 500 euro note, but about the ceilings as well when it comes to the quality effect. Banknotes are the only unlimited means of payment at the moment, and any restriction will always mean that banknotes will no longer have that quality, but you have to use non-cash, which is not central bank money as such, and comes under financial risk as well, book money that is. There were 3 questions. Monetary policy, very briefly, You hinted that monetary policy is a risk management strategy. I think that this would be a significant change of monetary policy strategy. And I wouldn't see it that way. There is a clear goal, price stability, and our monetary policy measures are geared towards achieving this medium-term objective. Now, if I got you right, if you turned monetary policy into risk management policy, saying that the deviation from the goal or target is not significant, but still you would want to absorb certain scenarios that are very unlikely but would be terrible, and acting now to prevent that potential scenario, that would be a strategy change which would have to be discussed fundamentally at first. Now, irrespective of that theoretical consideration, I currently don't see the risk of deflation. That's what it boils down to. And by deflation, I don't mean a decline in the price indices over one or perhaps several months. No, I mean a self-reinforcing downward spiral with the negative impacts on the real economy associated with that. We are far away from that range. And over the projection horizon, we will move away from that. So the discussion on deflation is a discussion that I think is hypothetical. Thank you for the detailed answer. That gave me the time to find the numbers in detail. You find them on page 93, on net interest income, for example. But the two numbers that you mentioned, the S&P portfolio, the net interest income was 1.684 billion for 2015, 405 million as a decline year on year, which doesn't come as a surprise because some paper matured in the S&P portfolio, reducing interest income. And deposit rate, 42 million euros as income from the negative deposit rate. The next question from Mr. Akagada in the middle here. My name is Akagao from the Nikkei, and I have two questions. One question is about the G20. You said that you're not expecting a sharp downturn of the Chinese economy. This week, the G20 are meeting or will be meeting in Shanghai. What will be the challenges and items that will have to be discussed there in your view? My second question is about government bonds as a market. And you kept referring to the market principle. The low-rate environment and QE could lead to a situation where the market principles relating to government bond markets might be impaired. But even as such, the market principle is not really at work, and that's why the highly indebted, stressed countries continued to be able to sell their debt instruments. How can we win back the market principle? It's always risky to ask me questions about the general framework of monetary union. Perhaps you have a question for Mr. Nagel about numbers, because I might be quite lengthy in my answer. Let me start with your second question first. You're totally right. The two factors, or safeguards, if you want, that were established to ensure sustainable government fiscal policy and also to protect monetary policy against the pressure of ultimately monetary financing of government debt, those safeguards haven't worked out as the founding fathers of economic and monetary union thought or hoped they would. On the other hand, we saw fiscal rules being expanded and made more flexible over time and again, where Germany and France were some of the key drivers. And we also saw that some of the risks that became clear in the financial crisis weren't properly priced in. before the crisis. My view is that there are several factors leading to that situation, which would now have to be adapted and changed to put the system on a more sustainable footing. One reason might have been that the no bailout clause wasn't really credible. And that is why a discussion is needed about how restructuring of government debt can become possible without pulling down the financial system as a whole. So delinking governments and from the system is key in that. Another reason is that when it comes to banking regulation, the illusion was maintained that despite the no bailout clause, which would mean something totally different, government bonds in bank balance sheets were free of risk, and the crisis has made it very clear that government bonds are associated with risk. And that is why the measures that the Bundesbank has been suggested for a number of years hope to solve that. The no bailout principle to be put on a firmer footing and a risk premium for the risk, reflecting the real quality of government finance, with the hope that those two together with strengthened and reinforced rules, but when it comes to the Commission, the actual binding effect hasn't really increased. So together with all these changes, we hope that will lead to more sustainable fiscal policies and a fiscal situation. But you're totally right in general, because these haven't worked, we have to tackle them. Now for your question about the G20. What is my expectation for the next G20 meeting? Let me say, first of all, this will be the first meeting of finance ministers and central bank governors under Chinese presidency, which makes it a very special meeting from our perspective, because holding the next presidency, being part of the troika, I was going to say, we shouldn't really anymore, but we'll be part of the three managing this process together. So probably I will only be able to report to you after the meeting what the real focus of Chinese economic policy is. What I can say right now is that the goals of the Chinese presidency are quite in line with what I would call our focus. What our focus is, structural reforms in these countries, and how to measure progress towards that goal include some points of a long-term growth strategy that we see as positive as the Bundesbank as well. Financial inclusion was mentioned as one of the topics to be discussed. And I think, especially together with digitization, this is very interesting for the debate. Of course, our reflections are always towards pursuing that and strengthening that under our presidency. So whatever is discussed has also to be seen in that perspective, based on what we'll see in China at the G20 meeting. Irrespective of that, there are some other calls which are not really so original anymore. I think from America yesterday, where the G20 was called upon to adopt concerted action in favor of the monetary policy and fiscal policy leeway to be fully used on the one hand, but also to provide additional impetus or stimulus. That is a discussion that will play a certain role, but it is certainly not new, not in any way. We saw repeatedly that global growth expectations were disappointed. In my view, the main reason of that is that the growth potential, the growth opportunities, if you want, the growth opportunities triggered by monetary policy were overestimated. And in my view, that proves more how we can see to it that structural reforms are actually seen through and the actual growth potential is strengthened instead of launching more demand-driven programs. And incidentally, I'm not convinced that the growth rates before the crisis that were characterized by overshooting should be the best possible benchmark that we should use for today's growth rates, which are also strongly characterized by readjustment processes after the crisis, the deleveraging program, things that have to happen to make sure that we get back to a more sustainable trajectory. Something that will be new and that we'll be discussing is this. At the meeting on the global economy, we'll have to discuss the magnitude of oil price, the oil price fall and volatility in energy markets in general, and their impact on global growth. And I think the view based on a consensus that the overall effect is a dampening one. Nevertheless, even for the global economy, we see a gradual upwards movement. There's one thing that's not quite clear to me when people are calling for things, is what this is really about at the end of the day. When you break it down for the different countries, then I think it becomes clear that this discussion will probably not be very far-reaching or not be able to. Look at Germany. We have normal capacity utilization. We have quite a good economic situation. And relating to Germany alone, monetary policy has been too easing, and we have pro-cyclical policies. Does that mean that Germany should launch a stimulus program? In my view, that would be an answer that no economist would give you. Not on an abstract basis, that is. Germany does not need a stimulus program, and it would not have the impact internationally that some would hope for. In contrast, there are totally different challenges, high debt levels, and that would mean fiscal discipline rather than strengthened expenditure programs or increased debt. And in my view, and you will know that this is my view, monetary policy is not a panacea when growth rates are going down a little. So I think this debate is not really conducive.
Next question, FT, Ms. Jones. A question on the Brexit and another one on the negative interests. What about the economic consequences that a Brexit would have for Germany and the Eurozone? And the second question, what's your view on a multi-level system of negative interests? Well, first of all, congratulations on your German. I think that's the first time that you put a question in German. I'm looking forward to the next interview with you in German. Now, on the Brexit. I think that the economic impact would actually depend on the very shape and form of contractual clauses then between the Union and the UK, because that would really determine the long-term impact. Something that we really can't say anything about now, because the Brexit is just a possibility, but it's not necessarily about to happen. So I can't really offer a satisfactory answer as far as that is concerned. But I do believe that one thing is clear, and that is both the EU countries and the UK have profited from the economic and financial integration. And I do believe that it is in the interest of everybody involved that will keep Great Britain as a member of the European Union. Maybe not monetary union, that's maybe a bit too much. So much for the Brexit question. The second question was about a staggered system for interest on deposit. Now, please bear with me. I see you there. So I do believe that you bear with me when it comes to monetary discussions. I don't want to anticipate or preempt anything that is to happen in the Governing Council, and I don't want to speculate about it before we see any need for action there. But as far as separate instruments are concerned, which in the way in which they're implemented will have different effects, that's something that we can all take for granted. So it's your central bank that you can expect that they will not just, or that we will not just discuss the existing instruments, but also possible alternatives which might increase the impact that these instruments can have. Ms. Littmann, the next on my list here. Exactly. Thank you. You mentioned before in passing that there was some escapism, people moving into cash because of the negative interests. So where would you actually expect people to take refuge into cash? At what interest rate? How far could that go? And as far as the asset purchasing program is concerned, there is a limit or a rule so far that these assets are only bought once they're above, as long as they're above the deposit interest. Might that rule also be abolished in the near future? As far as people taking refuge into cash is concerned, now we keep seeing this in different currency areas, if you want. So people have started to look at the bottom line than the zero lower bounds. We had assumptions minus 0.3%. People said before that that would be the point when people would actually turn into cash or towards cash. Now alternative costs would come in here, opportunity cost. The cost that you actually have when you rent safe deposit boxes, when you want to transport your cash and insure it. Now, there are numerous central banks that have already gone beyond that limit or threshold. And even there, at least for the time being, who haven't seen any significant movements towards cash, so that the effectiveness of this measure would be called into question as a matter of principle. So to answer your question, it's very difficult to say. We cannot state precisely what that threshold would exactly be, but what can be seen, and I'm sure you see that just as we see it, what we can see is that there is a certain interest when it comes to players in the financial markets, participants, financial institutions, to get some ideas or look at how significant deposits of cash could be managed. So this is something that we as central banks, of course, are aware of, and we have to be able to manage this. So I'm mainly referring to institutionals here, not retail clients. Second question. Oh, deposit interest rates. Oh, the BSPP threshold. So I wouldn't have such a limitation of the program, let me put it that way. I wouldn't really want to discuss this here, because purchases below the deposit rate would actually lead to a situation where the buyer would certainly incur a loss with the purchases. And so some additional questions would certainly crop up then, which would make the implementation of the PSPP program much more complicated, and they're also of a very principled nature. And I think it's not necessary to discuss it right now. If I may, Jens, to add something here from the market point of view. Now, this discussion would actually mean as if you'd be arbitraged out as a central bank. You buy below the deposit rate, the banks will actually absorb the liquidity and then, of course, deposit it in the deposit facility with us. So to put it very bluntly, I could just transfer the difference, the delta, directly to them. It really doesn't make any sense. Mr. Arons had asked for the floor. Okay, Ms. Drake maybe first. Here she is, here in front. Thank you. Two questions again. Concerning the instruments and how they can be established or shaped, you say they can be changed. What about changes? Anything that would actually lead to legal worries and concerns on your part? And the second question would be, you stated before that the monetary policy mustn't ignore the risks for financial stability, and that you got a new study about that that also confirms that. What does it mean in this present situation for monetary policy then? As far as the program and the structure is concerned, or the way in which it is set up, there are a number of limitations for the PSPP that I consider very important, but more for economic reasons than for anything else. Economic reasons, of course, that are also reflected in the legal evaluation later. That was the discussion we had before, last week also, with the Constitutional Court. But that's a different matter altogether. I'd like to give you an example. The ceilings here for issuing. So the Governing Council actually set the ceiling not at 25 but 33% now. And they were determined in order not to undermine the intention of the CACs, the restructuring of the debt clause. I don't know how far I have to go. As long as I see you nodding, I'll keep talking. Now, one lecture of the crisis, one lesson was that restructuring of sovereign debt was to be made easier. Therefore, the agreement was to have restructuring clauses for the new debt for states, which actually would make the creditors more flexible, and which would actually make a restructuring of debt more probable in a tidier way. 33% have to be seen now with the minority rights at these creditors' meetings or assemblies, because there is the prohibition of monetary sovereign financing, so we must not renounce as far our receivables from states. So if we were at a creditors' meeting, we couldn't just say, okay, we bought some sovereign debt, but we don't want to have it redeemed anymore. So we do a haircut. We are not allowed to do that. So at creditors' meetings, we should actually vote against debt restructuring, which, with a share of more than 33%, if we had this, if 100% of the creditors were actually present there, which will never happen. But anyway, such a restructuring would have to be inhibited or prohibited by us, and then we'd have an unstructured restructuring. That's why we've got the 33% limit, connected also again with the prohibition of monetary sovereign debt financing. And of course, the larger the share is that a central bank has in the debt of any given state, the larger the share is, the more there might be the suspicion that the prohibition of monetary sovereign financing is circumvented, as with the primary market, as has also been suspected in the primary market. So I consider this to be very important, and it needs to be kept also in the interest of the ECB Governing Council. And the second question? Financial stability. As far as this is concerned, it's not really that different from what we've kept discussing here. Monetary policy, with the decisions taken there, so and how far does it need to take into consideration any impact on financial stability? So my answer would not be looked at separately, that it's other macroprudential instruments that ought to be used here. But of course, financial stability risks can have an impact, for example, on the ability of monetary policy to guarantee price stability. the transmission channels. And that is what is also behind the second pillar of the ECB strategy and the view onto the monetary aggregates that we focus very much on in contrast to other central banks. And basically, in the final analysis, this means that the long-term impact must not be ignored altogether if or when they might have some impact on the price stability.
Mr. O'Donnell, microphone for you. You mentioned that the banks are strongly affected by the low-rate environment. How long will the banks be able to keep it up? Would it be possible that banks might have to be closed down in Europe if it takes too long? And you also said that monetary policy has reached the end of its possibilities. I didn't really say that. Okay, you hinted that the options for monetary policy are limited. How do you see the future? Is it perhaps time to think about stopping the easing policy and even thinking about rate cuts for the coming years? Yes, I do hope that at some point rate hikes will come about for the one reason only, that monetary policy should normalize at some point. But I haven't mentioned any time, okay? Don't get me wrong. And I didn't say that monetary policy has reached the end of what it can do. I mentioned the instruments, first of all, discussing the necessity to act, and then discussing the monetary policy instruments. And if you see a requirement to act, and this is where my perspective might be a little different, but if the reason to act is established, then the different instruments have different problems. Buying government bonds is associated with risk, the risk of linking up monetary and fiscal policy, and that is why I see that as more critical than other instruments, which is why I believe this should be reserved to a potential extreme scenario that I don't see at the moment, to be able to respond to that as an emergency instrument, but it doesn't mean that we don't have any other instruments. When it comes to the earnings capacity of banks, I set out earlier that during a transitional period, when it comes to the rates, there are three factors that have an impact on interest income by banks: change of risks, the level of risks, and the rise of the yield curve. And during this transition period, there are positive effects on interest income by banks, which I tried to describe to you. And the longer the low-rate environment persists, the more problems will arise with respect to the bank's earning capacity. Even more so if at the end of that period that is associated with an interest rate shock and potentially even macro risks, high default rates, for example. That would then be a situation which we'd be concerned about. And that is why we respond to that. For example, by changing the frequency by which we talk to the banks, by calling for more reports, special audits that are then set, and the survey I mentioned among 1,500 small and medium-sized banks. It's not only in a monetary policy capacity that we're called upon to look at that, but also as supervisors. And in that supervising capacity and responsibility, we'd increased the frequency, intensity by which we closely monitor banks and their potential risks. The next question, Mr. Siegemiedl. Mr. Weidmann, the debate about the asset purchase program at the beginning also led to a discussion of what it would mean in terms of net profits for central banks. Could we say that so far this has been excellent business for Deutsche Bundesbank in terms of business? Well, business is not really part of our mandate, so that would be the wrong benchmark, the wrong yardstick for a central bank and its accounts. And actually, the argument itself is deluded Of course, we could make, theoretically speaking, great profits with all the firepower of creating money, buying speculative assets, making sure that they won't default, but also through money creation, which would no longer be in line with our actual mandate, which is securing price stability. And that is why this is a discussion which is relatively irrelevant to monetary policy and us as an institution. The decision is not about buying bad assets from other banks' balance sheets to do good business. That is not our mandate. We are far more than a buyer in the market. We have an influence over the environment as well in terms of monetary policy and also supervision, so the criterion itself is wrong. Next question, please. Mr. Weidmann, you spoke about the potential of the EU that has to be tapped, and you mentioned a few points. The architecture of monetary union was one of them, and that it should be repaired. You showed two ways: the fiscal union first, and second, solving the weaknesses of the current architecture of the union. But you skillfully and clearly avoided to position yourself between the two ways forward. My question is, how do you see your mandate predominantly? Do you see it as seeing to it that mistakes in repairing the system should be avoided, or are you saying that the goal should be fiscal union at some point, even though you might not want to give an opinion of your idea of the timing? Let's get the microphone to work. Thank you. It's good. That reduces the questioning time. That's good. No, on a serious note, ultimately, for me, it's important to make it very clear that this is not a decision by the central bank. The central bank is responsible for monetary policy and ultimately sustainable policies and the general conditions and the general environment which has to be sustainable. And you have to make sure that the actions and their consequences are assumed, if you want, by the same organizations, by the same people. And of course, our policy will only be successful when the general environment is stable and stability is protected. And that's something politicians have to decide and not central bankers. But what we do need and call for as central bankers is a discussion on the necessity of that and a discussion on what that architecture should look like.
Here we go. Here we go. So pressing the button, everything's fine. The central point is that, of course, the markets have got the different preferences. For me, it's all about stability. And that we do the right steps in the right sequence in order to get to where we want to get. Making sure, for example, that there is no sharing of liability when it comes to nationally taken decisions. And that's also why the deposit guarantee, the joint deposit guarantee, is something that I see in a very critical light. Because when you look at balance sheets of banks, decisions are taken on a national level. Banking balance sheets, of course, reflect the national insolvency legislations. And of course, there are other national influences on the balance sheets of banks. So it's the sequence that's important here. Next question, Mr. Schreurs. So he'll get the microphone now. Thank you. Two questions. First of all, you said that the deposit rate would be the lower limit of asset purchases, and that was not to be changed. What about the pro rata system of ECB? Would that be a point of discussion, or would you say that this would change the monetary character of the program and therefore not be acceptable. Second question, the problems that we've seen with European banks in the past weeks has led to more discussions in how far monetary impulses can actually be transported via the banks, heating up the discussion whether ECB could actually specifically circumvent banks. Helicopter money, that's the buzzword. Is that completely off for you, or would that be something for ECB to look into, this type of instrument? I don't want to actually look at the different points of the PSPP and assessing everything in detail, but I think in view of what I've already said about the incentives for budgets, it wouldn't be very pragmatic to say if central banks bought in particular assets of those countries which were particularly noticeable because of a lack of budgetary discipline, or fiscal discipline. This would lead or might lead to misinterpretations. There are some innovative proposals, in particular from science and academia. However, I do believe now, when you understand what helicopter money is all about, you wouldn't really assume any longer that it would have significant effects. In particular also because there is paragraph 123, which would actually be violated to a certain extent, and also the definition of monetary policy. So central banks would actually transfer money directly to the citizens. So I send you a check, and the same would be done by the Italian central bank. So it's like some social benefit that people get. And in a democracy, it's parliaments and governments that ought to determine that or decide on, and not the central banks. So this is where a very difficult discussion would start already, a discussion of the mandate of central banks. But what would it actually mean in practical terms? It's not that we buy something like that with balanced accounts that way, but the transfer would actually lead to a gap, a hole on our balance sheets, something that would have to be reduced over time. So, seen over time, it would actually lead to a reduced profit of the central bank, which shows you again that it's definitely a fiscal measure, because it's just a different type of financing a social benefit or a transfer using a profit of a central bank and not incurring debt. Once you've understood that, I think when you then look at the effect, you might also have a more differentiated attitude. In particular, because when you look at a loss on the balance sheets of a central bank, there are some other questions that would actually need to be answered. For example, concerning the limitation of the loss over time, the question whether it might grow over time, leading then to a destabilization of the situation, etc., etc. So, all very interesting in theory, I'd say, but as far as practicality is concerned, there are certainly some severe difficulties. So I think the balance sheet description, I see our controller nodding, so apparently my description's been correct. Ms. Inigels in the back there. Another question. How do you actually assess the situation of Deutsche Bank? And the case of the exchange there a week ago, or let's say when you look at Deutsche Bank and the stock exchange situation over the past year. And what about the other German banks? So I'm not going to answer your question, although, well, concerning the helicopter money again. I think it also illustrates that monetary policy is considered a cure-all, and it is no cure-all after all. In the present situation, when you actually look at these exotic and dangerous instruments, exotic and dangerous when it comes to the independence of monetary policy, so to actually propose or ask for that, I think it would be wrong. I think it is wrong, because it would have a negative impact then when it comes to the actions taken. It's something that the central banks, of course, have also furthered and supported that. In the end, it's going to be the central banks that are going to help anyway. So Deutsche Bank, and I never comment on individual banks. As far as the volatility in the financial markets concerned, I mentioned this before. For me, it's also a certain assessment or valuation of the profit capability or outlook of banks. Volatility is reflected because of risk situations. So should it stay at the level that we got now, it can have an impact. It might have an impact on growth, because financing costs, of course, become more difficult for companies.
A question by Mr. Toussaint. Good morning, Benoît Toussaint for Agence France Presse. I have two questions. One is about communication. In December, the ECB disappointed expectations, very strongly so, and some central bankers actually fed this disappointment. Mr. Draghi said in January that the ECB will review its policy in March again. And more recently, high expectations have been fueled again. I would like to ask you whether you see the current communication by the ECB as a problem. And more generally, is it your impression that all these statements might force the ECB to act? I have a second question too. Today you said that you see the current ECB policy as risky. How do you personally feel on the governing council of the ECB? How do you see your role? Do you have the feeling that your voice is being heard when it comes to pointing out risks and so on? These are my questions. First of all, when it comes to expectations, I guess you should stop over-interpreting statements by central bankers, because it's always about two when we talk about communications. No, that was on a joking note. On a more serious note, ultimately, a central bank also uses communication as an instrument of influencing market expectations, that is. And that in particular in an environment that we're in right now, where the monetary policy stance on both sides of the Atlantic is different, despite the more recent corrections. Against that background, everybody making a statement, including myself, I make public statements, will lead to other people drawing their conclusions. And everybody accordingly will have an impact on the expectations. It's only that the expectations must not become the benchmark of a monetary policy action. Because you think something doesn't mean that we should do it necessarily, and then maybe we'll have to accept some juddering in the financial markets when deception is produced. And we shouldn't look so much at the short-term financial impact of our statements. I feel at ease on the Governing Council. I sit between Vito Constancio and Ignazio Visco. I like the people sitting next to me. There's enough to discuss and talk about. And to be totally honest, I'm not really so concerned whether my arguments are heard or not. It's clear that we don't always have the same opinion. That would be a shame, really. Otherwise, we could stay at home. I wouldn't have to meet or delegate the decisions. But look at the PSPP. The PSPP shows one clear distinction compared to previous asset purchasing programs, which is essentially based on the discussions in the Governing Council and based on the concerns of some members, including myself, but I was certainly not the only one, that loss sharing in the context of our monetary union with independent fiscal policy, but a common fiscal policy is a problem, and that was changed in the new program. Limits were established, safeguards, measures that I think are useful and make sense, and so do other members. When you look at the public statement of some governors, you also see that this is really a continuity of opinion. It's not Mr. Weidmann at one end and all the others at the other end. Opinions do differ. There are nuances, and of course it's always ideal to discuss things with somebody who has a different opinion from yours, so the discussions are always exciting when it comes to the Governing Council. Mr. Sabel had a question. As how high do you see the risk of a return of the euro crisis? In Portugal, you have a government wanting to turn back the wheel on reforms, and insecurity in Spain when it comes to politics. In Italy, the deficit targets are questioned. Well, what can I say? That is exactly the challenge that I try to keep emphasizing. You're referring to exactly that in your question. To come back to your question, we have to avoid an impression where monetary policy is seen as the firefighter. If fiscal rules are not as binding as they should be, then the discipline effect of the market is simply turned off, so to speak. And if that happens, we must not be surprised if this fuels developments that are not in line with the price stability requirements of the monetary union or general requirements of monetary union. And that is something I do see as a problem. And I also see this as one of the risks in monetary union. And that is why we have to establish a sound framework, but we also have to look at what some countries are doing and whether Spain or Portugal continue the previously embarked upon consolidation process. Implementing structural reforms is included in that debate. And what's also included is how the Commission will deal with fiscal or budgetary rules in the case of Italy and the extent to which Italy sees itself as bound by this with a deficit rate which is substantial. But it's not acceptable that we should not accept risk-based pricing of government debt, and really rejecting regulatory changes that the Bundesbank is suggesting, which would only eliminate a distortion associated with risk to financial stability and a burden on private sector loans as well. That cannot be the answer. The answer will have to be a balanced budget, making sure that rates, or interest rather, for the country are actually manageable and acceptable.
I see there are no further requests for the floor, so enjoy the remainder of the day.